Hello and welcome to today's IntelliCredit webinar on the adequacy of loan review strategy in what is, I think, inarguably some changing times in the credit world. One of the reasons we wanted to offer this is traditionally a time where a lot of client organizations or financial institutions look to the following year to determine scopes, budgets, and things of that nature, particularly towards loan review. I think hopefully you'd see this as timely. Don't think, as I just mentioned a moment ago, I don't think there's any doubt at this point that there's some heightened credit stress, largely as a result, of course, some inflation and the heightened interest rates that we've had to incur the last 18 months or so. And we also know that from our loan review work, third-party loan review work, we certainly are seeing the highest level of some downgrades. Fortunately, most of those are in the past categories, but the most we've seen arguably in years and years in the last 6 months. But I think those of us that are on this call, hopefully that are in the focus of managing credit risk, do buy into the age-old axiom, and that is early detection of credit problems correlates very much to lower losses and even at some level to lower workout problems that can be very distracting to banks' credit teams. So I've been around for a while. I've been in the credit business for many years. And so again, thank you for letting me share kind of what I consider to be best practices relative to loan review. But this is your webinar in many ways, and we wanted to intersperse this presentation today with some interactive polling to kind of get your perspective of where you see loan review from. So it's going to be very, very easy to do this if you just take your phones out and scan the QR code. That immediately activates your ability to participate in this poll, and the same convention will apply throughout the entire presentation. So if you don't mind, just answer these questions. Do you use in-house loan review? Do you use third-party vendors? Do you use a hybrid of the two? And we're really talking now about independent loan review. Please don't confuse that with annual reviews, which usually is done, as you know, typically internally. Okay, so it's pretty much a good split with in-house and a hybrid of the two. That's very interesting. So third-party vendor is actually the minority in this case. Okay, the next question is, what would be your concern or your thoughts on the two most effective post-booking credit risk lines of defense? We're not talking about underwriting or policies. We're really talking about post-booking, how you monitor credit stress or credit issues post the booking. You see the options here: risk rating, past dues, annual reviews, things of that nature. So good. Again, I think that's interesting. It's changing a little bit as we speak. So many of you do focus on past due reports. That's true. I will go ahead and say, from my personal perspective, you want to be assessing this or dealing with this or monitoring this a little bit before past due reports, hopefully. But certainly that's probably the most traditional flag that most people look to credit problems. Okay, the next would be, how would you rate the effectiveness of your bank's loan review? And we're talking strictly the independent loan review part of it. 1, obviously, to 5, so in terms of quality. Okay, so it's certainly the general indication trend is that you're generally satisfied. I do think part of the discussion today should be about how do you even make it better and more effective, because, we lived in arguably a decade of very benign credit performance. And let's be honest, sometimes loan review just as a checklist item either internally or for auditors or for regulators. But I certainly think now may be the time, as we begin to see some heightened stress, that we do everything we can to enhance our loan review and what it tells us. Okay, so I never believe in speaking of anything in the abstract. I think you have to accept the landscape of what's going on in the credit environment right now. So we'll spend a little bit of time on that part of it. So I'd like you to this is a word cloud, so you basically just in 1 to 3 words, describe what you think the current credit environment is as we speak today. Could be benign, could be increasing risk, something along those lines. This is not unpredictable. Increasing risk. We've been doing these IntelliCredit webinars for goodness about 5 years now, and the predominant theme has been uncertainty. I think this is showing that you all also see that that's somewhat been replaced by heightened risk. So again, thank you very much for sharing that, because I do think it's very important that we learn. It's a two-way street in our world. We always learn from our clients and also participants in webinars such as this. So I'd like to start with, again, the credit environment right now has presented a challenge, particularly for those of you, and I know the predominance of the attendees today are with community banks and smaller regional banks. But this is really what I call a tale of two loan growth scenarios. And that is in the large bank environment, this FDIC chart actually looks at the entirety of the commercial banking landscape. It includes smaller banks and mega banks. But as you can see, balances in loans have declined in the last last quarter in the entire industry. The trend line has been, after a big peak about a year ago, the trend line has been for a little more tepid loan growth. But the reason that I'm sharing this is if you look at just the community bank space, there has been actually more growth, particularly in certain areas of real estate. So I do think that's a theme I'd like to emphasize throughout the presentation. We all know, again, this is going back, this is capping. We use our sister division, Quick Analytics, as data metrics on this. These are banks capped at $10 billion in assets. So as you can see, the loan growth, at 12-month average loan growth, has begun to tamp down a little bit since about a year or two ago, where there was so much robust. But we also knew and learned this lesson quite well during the financial crisis, and that is the art of understanding and monitoring vintages. And we're not talking about wine vintages here. We're talking about loan vintages. Again, the lesson we learned was that in the great financial crisis or the Great Recession, with all those failed banks that we had to experience, that about 75 or 80% of the losses incurred by those banks occurred from loans that had been made 12 to 18 months prior to the 2008 so-called collapse. And so, again, the lesson there was, as you go through a spurt of loan growth, which we did as a community bank industry about a year ago, we've got to realize that we got to keep an eye on those loans, because historically they prove to be sometimes the most problematic when credit stress really begins to hit, for a variety of reasons. They don't have time to amortize. They may have been booked in a spirit of almost aggressive loan growth, the feeling that that's what you had to do to buttress your financial performance. And again, embedded in those spurts of loan growth sometimes can be the seeds of future problems. There is no question that the big divide in credit performance, it still seems to be more of the consumer purpose lending is leading the parade, if you will, on at least documentable credit metric stress. Um, the business or commercial loan types are trailing in that regard, but we're seeing upticks in most of those. This, of course, is for Q1 24 from the Federal Reserve. As far as a kind of a thumbnail read on general credit quality, and again, in the banks under 10 billion in assets, you have on the left, you have a chart that shows kind of what I would call the inventory of NPLs or non-performing loans. As you can begin to see in the last couple of years, actually, last 18 months, you've begun to see an uptick in that. You're beginning to see somewhat of an uptick in charge-offs. These are determined through a comparative graphing of regions of the country that IntelliCredit puts states under and banks under 10 billion in different regions. The blue line is the national, the others are indicated. The ACL to loans, which of course is the new moniker we use. We don't use ALL after CECL, it's the allowance for credit losses. As you can see, there is somewhat a disparity between banks in the West, which are averaging 151 basis points of allowance for loss versus the Northeastern banks, they're at 100 basis points. So that's kind of bookended by those regions. Another way of looking at it is, of course, that how much of your known problems in banking are covered by your current reserves. Again, as you could see in the previous slide, there's not a lot of problems that have arisen to non-performing loans. And you've certainly got adequate coverage multiple times in your current reserves. It's not even to talk about, of course, capital cushions. But here's, again, one of the things that I wanted to highlight, particularly for community banks. As you can see, the trend line is going down a bit. Large banks, on the other hand, have significantly increased their reserves over the last 12 months, largely because of the fear of two things: either consumer debt, which many of these smaller banks don't have as much exposure to that now, but certainly also to CRE. So community banks are trending down, certainly in terms of the growth rate. I admit that the last quarter there was an uptick in community bank reserves, but it still did not match the pace of what big banks were doing to add to their reserves. And again, the real concern that I have personally in terms of a disparate impact on community institutions is that the larger banks and virtually all the other providers of credit in the U.S. economy are seemingly decreasing their exposure in CRE, while community banks almost exclusively, the bulk of their loan growth in the last 18 months has been added CRE exposure. Again, that just puts more onus on those financial institutions that are a little smaller or would identify as smaller regional banks and community banks to be sure you defend your strategies on further increasing your CRE exposure. We all know this has been the primary dominating news item. It goes all the way even to the liquidity issue, but also certainly the impact, as we said earlier, on higher interest rates on credit quality. But as I indicated earlier, I've been in this business now 50 years, and this is kind of the 50-year look on perspective on where interest rates. In theory, you could say, well, we're really kind of at normalized interest rates now, but obviously we had such a record velocity increase a couple of years back that really put kind of a shock on a lot of the borrowing public, both commercial and consumer. Texas ratio is still kind of flat. The only issue, many of you have heard me say this before, again, disproportionately negative to community banks if it starts turning upwards, because you've got more dependence on real estate, number one. You also tend to know borrowers more closely than the bigger banks would have. And you don't have the capital cushion that some of the larger banks would have. So what are some of the current credit concerns? One is that, again, that if you look at macro data, and a lot of that is, peer compare, call report information, those metrics are still not showing significant upticks. But you got to remember there's a strong bias in call report or public data that basically says the credit almost has to be dead before it gets reported. And again, I think those of us on this call we like to think we're good at credit risk management, understand the real art of credit risk management is on the pass grades, and where softness or hotspots are emerging and trends are emerging well before it gets to criticized and classified status. There's still problems in post-booking inconsistency. Some of that we're seeing. Certainly the rate and inflation environment are beginning to take a toll on not only consumer borrowers but businesses. Again, the bifurcated American consumer seems to be between paycheck to paycheck and those with more healed balance sheets with 401ks and so forth. That's beginning again to take a toll, particularly in financial institutions more heavily concentrated on consumer loans. As I said earlier, we've clearly seen heightened risk downgrades than we've seen in probably a decade in our work with our clients. There's no question now that regulators are becoming far more aggressive, far more assertive, particularly in areas such as looking at your credit processes. I don't see a whole lot of examples where regulators are going after banks on transactional credits, forcing them to downgrade individual borrowers or asking for more robust non-accrual status to be imposed on borrowers. But I'm certainly seeing tremendous amount of focus on credit process, and particularly as it relates to the CRE area. Now, part of that is something that I think got underreported in the financial presses, and that was that much of the regulatory community reacted in a stunning way over those 5 banks that failed in 2023. I might add only one of those was credit related, a very small bank in Iowa. Most of it was funding and liquidity, as we all know. But what those 5 banks did is they equated to about 483 banks in the Great Recession in terms of the FDIC insurance fund potentially impacted. That obviously sent some shockwaves through the regulatory community in terms they wanted to make sure there was no contagion of major problems within the banking industry. And it has led then to the field examiners being using far more scrutiny on what has been the experience in the last few years. Again, credit, as we all know, is a long-term issue. It doesn't, so much of the financial press is fixated on, quarter to quarter to quarter performance. That's not how credit works. A perfect example is we're having to deal with the big aircraft carrier battleship of credit turning slowly, even as a result of the rates and inflation. A perfect example is estimate of $1.5 trillion of repricing in the CRE categories alone, just until by the end of next year. And that just inevitably has a drag on particularly debt service coverage ratios. Again, I mentioned this a moment ago, small banks have led the parade on growth in CRE, while the others are seemingly fleeing from that. So the question I have on this segment to those of you on the call today, what are your bank's 2 largest CRE subsets? And again, this is a primary focus on the regulatory assessment of your bank's credit process. They're not so focused on the 100-300 guidance, as we'll talk about in a moment, but they're certainly wanting to know where are you on the various subsets of your CRE exposure. So you have several options here. That's very, very interesting. And I think most of you concur, owner-occupied in theory is like a C&I loan, right? In terms of underwriting, it kind of sits there as an oddball in terms of CRE. But it is interesting in this survey here that multifamily is at the top, and I'll talk about that in a moment as a growing concern of mine. So we talked about the 100 and 300 guidance. The chart on the left, of course, is the more subset of the broader guidance that was issued in 2005. And that is the 100% of your risk-based capital. If you exceed that in these categories of construction, development, and acquisition, then you do need to have a little more focus on defending your strategy for that. Not unexpected, of course, the Southeast and the Southwest lead that effect on risk-based capital, because they tend to be right now in the markets that are experiencing more demographic growth and business opportunity, leading to more construction. So it's not at all implausible that that be the case. The broader issue of the 300 guidance, they're the Western states and the Northeast that actually have the highest level of that. The Midwest banks are kind of the lower end of both of those measures. As you can see at the bottom of each chart, it tells you the number of banks in those respective categories that have exceeded those guidances. Again, that's not a regulation violation. It's just a guidance issue. In other concentrations that we traditionally look at, and I'll mention here when I said a moment ago my concerns about multifamily, you see here the Northwest and the West lead in that relative to risk-based capital. My biggest concern in multifamily is that over my long career, it's always been like a seesaw relative to 1 to 4 family mortgage business. For a variety of reasons now, with the rate increases and the high cost of housing, the mortgage industry has not been very robust lately. That tends to particularly channel those paycheck to paycheck individuals into rental housing. There's been a burst of activity in multifamily that tends to start ebbing away as soon as you ever get back to a normalized mortgage industry. And I do think that's important that we understand that. I might add that there's some Q&A and chat here maybe going on. I apologize, but I may defer until the end to go back through that and certainly answer any questions you have. C&I, and again, the reason I think multifamily is so of some concern of mine is not only what I just said relative to the mortgage industry, but it's also getting squeezed from both ends. They can't move but so much rent increases upwards. The renters just don't have the capacity to pay that. And the second thing is cap rates increase, the valuation of these projects decrease, as we all know. So that as a loan product and an investment product, in my opinion, right now is losing favor. And I do think for those of us in the banking industry that got exposure in multifamily, that needs to be, frankly, pushed to the front burner in terms of just monitoring and concern. C&I has returned, as you know, to its more normalized levels since the PPP program. Ag, not unexpectedly, the Midwest leads in that. Again, these are not farm credit numbers integrated in it. It's just strictly commercial banking. Let's go to this is the big reason that we've got concern. I think this chart to the left does depict a year or so ago how much further involvement the smaller banks are having in financing CRE properties, where all the way out to the other end of the spectrum, where you've got CMBS, insurance funds, people like that, government agencies, private equity, they're reducing their exposures. Someone said not long ago that the REIT futures market had virtually collapsed because there was not a lot of interest in increasing exposure to real estate. This number as of first quarter provided by the FDIC to the right just again shows you the growth rate just in the first quarter of this year of community banks over twice, almost 3 times the level of the entire banking industry as a whole. Hopefully I'm not insulting anyone, but sometimes I think concepts are important to re-grasp occasionally before we get into the nitty-gritty of the sophistication of assessment of risk. But in the end of the day, anybody that's lending money on real estate, I think, understands this dynamic. When when the inflection point or the intersection is reached between demand and supply, you want to be on the left side of that intersect. It's usually the banks that get in trouble or have difficulty in their real estate portfolios that are in markets or loan products where the supply now outpaces the demand for obvious reason. This is at the heart of the regulatory criticisms and orders we're seeing coming out of the regulatory agencies right now, is that they want you to almost treat CRE exposure and underwriting as two halves of the same walnut. One being something we all know and can do in our sleep to speak of, I think, is underwriting the project and the borrower for repayment capacity. That's not an issue. Underwriting has never been better, in my opinion, than I've ever seen it. I mean, it's about as good as it gets. But the second part of that, the other half of the walnut is, which really puts us in a little bit of an added burden, is determining the market supply and demand for the footprints by which we're lending these and financing these CRE projects. That really is the heart of so much of the criticism that I'm seeing from the regulatory community. A perfect example is the Atlanta Fed has recently significantly improved what they call now the CRE market index. And I was teaching at the School of Banking earlier this month in Florida. And this is just an example of what I showed there. I said, Pensacola versus Miami, they may have quite different profiles of different types of CRE lending. And again, this just shows in Pensacola, at least from a market index, multifamily is the one of these four that showed the most concern right now. And again, same example here where you've got an aggregated point of that. One of the things I wanted to share with you is that I do believe some of these pointers that really frankly come from my awareness of board orders and criticism from the regulators recently, it stretches all the way again to use your MIS data more effectively, obviously focus on the subsets, not just the broader 300, 100. Make sure your policies are up to date because you can't be using 10-year-old policies. A number of banks, frankly, in our clientele have induced CRE lending by things like 3 and 5 year, believe it or not, 5-year interest only for CRE. That's not going to not going to withstand scrutiny right now. And I'm strongly urging our banks to update their policies to reflect current sensitivities, investor and regulatory sensitivities, but the marketplace in general. We'll talk about stress tests in a moment relative to loan review. I do think this is the time to expand your loan review, not necessarily shrink it. And I do think you've got to spend a lot of time making sure that the capital and strategic plans, your risk appetites, are not only discussed routinely at your board meetings, but obviously they're incorporated in a robust way through the board minutes. Again, that seems to be a common theme that, unfortunately, in this era that we live in, if it's not in the board minutes, it didn't happen. And it would be very difficult to defend that you had a verbal conversation about these things. Again, one of the things I just mentioned earlier is that this is the depiction of why we had such a focus on concern following the 5 bank failures. It's just a justification of where the comparison is in terms of the impact of the FDIC insurance fund. So let's talk a bit about where we are on your current loan review strategy. Again, this is really a composite of what I have felt like I have observed over many, many years in the industry, and one, frankly, that we've tried to embrace, or things that we've tried to embrace even at IntelliCredit. We've still got, to some degree, some fixation too much on just the large borrowers. We understand that comes with the territory. You want to you want your loan review to be able to have gone through some of this before a regulator does. Some of the scopes are still too small. I do think your concentrations are not reflected proportionally. Sometimes banks are not really correlating their emerging trends to their loan review samples. Again, I think sometimes people do focus too. So we have clients that will say, well, we don't even change a risk rate until they hit a past due report. I would argue that's not very wise, but that's certainly your prerogative. I do feel like stress testing is really not only now being required in so many cases, even though guidance wise or regulatory wise, nobody, I doubt many on this call are DFAST or CCAR level banks that are required to do it, but it's certainly being a constant drumbeat from the regulatory authority. We'd like to see more stress testing at your bank, no matter your asset size. And I do want to hasten to say, don't hold out for pristine reports. I speak a lot, including with regulators on panels, and they are quite frankly own to this issue of, they ask, when did the loan review get performed and when was the report issued? And if there are months that go by, they've made a general presumption that the bank is just holding out for a pristine report. They want it to look clean. You know, there's another piece of that. If you've got a lot of exceptions or you got a lot of initial concern at the engagement of a loan review, that should speak a lot to the credit process, for example. And that in and of itself is a risk point, not just individual transactional risk grade degradations. So what we would like to leave you with today is a suggestion of maybe looking at or embracing these aspects of a better, more effective loan review. We have a very strong bias in our IntelliCredit world of using only deeply experienced credit people. Irrespective of our modern technology, we feel letting people in behind the review process who've kind of been there and done that is frankly more effective. Some of the larger accounting firms, frankly, send out young CPAs to do loan review work. And while they certainly get the quantitative part of credit, they don't necessarily understand the quantitative yet, which is typically a learned experience. So I would like to ask you again here, we're asking your opinion again, do you request bios of your third-party loan reviewers? Because we're certainly recommending that, irrespective of whether you choose us or someone else. We think that's a very, very important diligence process that you should be going through in your financial institutions to determine who is doing your loan review. Well, that's heartening to hear that a third of it, more than 3/4 of you now are at least asking for that. Again, I've alluded to this distinction between why we think experienced reviewers, and there's another intangible to that now. Someone who has been in a credit role, been in a senior lender role, understands, I tell our people all the time, the only power we possess in a loan review is that of persuasion. We have no corporate authority over the bank. We certainly have no regulatory authority. We do have that power of persuasion. Typically, that takes someone who has been involved and is experienced enough to be able to frankly persuade potentially some reluctance in the bank to, or at least to have a collaborative discussion on why this credit may be deteriorating at a level, at a pace that the bank doesn't necessarily agree with. Again, in this era, please accept wherever you're getting loan review from. It's an asset. It's a part of your risk management team. It should be treated as that, not a kill the messenger aspect to it psychologically, even though I know no one likes to be told anything that what they're doing isn't up quite up to par. But I do think some of those kind of philosophical approaches to loan review need to maybe change as the heightened credit stress is coming along. We tend to believe in and do offer a documentation review contemporaneous to the credit review, so the doc experts, paralegals, if you will, screen the sample loans and borrowers for technical documents. Then it's handed over to credit specialists to look at repayment capacity and so forth. We also believe, as I said, get away from just the typical knee-jerk, let's do a random sampling, or let's heavily focus on just the large borrowers. I think a much more gradational identification of sample is in order now, particularly as we're seeing heightened stress. And where that begins is, of course, your unique idiosyncratic data at your bank. Remember, that's your DNA. No one, including a regulator, unless they're in the throes of your exam, sees your information like you do. Remember, this has nothing to do with call report data. This is non-public data from your loan portfolio prior to anything ever being reported to the call report. So I do think it's that. Unfortunately, less complex banks are a little behind the curve in understanding the importance of that, or even utilizing what now has emerged in the industry as much more practical and much more affordable tools to give them the ability to slice and dice. But that, again, is part of the IntelliCredit mission to provide that in a practical and affordable way. Examples of this would be to slice and dice and try to understand where your risk grade migrations are already beginning to show, where the concentrations, particularly if it correlates to a larger concentration. Obviously, logically, you would want to almost disproportionately load up your loan review sample with that kind of correlation. I think also in terms of deliverables, sometimes people that provide loan review really revert just to a chart that says, we agree with this credit if it's a pass loan. I tend to think that loan review owes not only an in-house loan review, but also a third-party loan review owes a lot more to the client or to the bank than that. I think you ought to have very robust summary reports that really do inform. It's not just a checklist kind of thing. They do inform about where the credit profile is, and really tries to do everything you can to emulate what best practices would be. And that also includes every time that a borrower or a loan, self-standing loan is looked at, it's a robust report is given for that. It's not just okay, we'll revert to putting that in a chart saying we agreed with the risk grade. Because this, again, the more you're looking at credits that have the potential for deterioration, I think the more you've armed yourself with a little more preventative aspect of this. Also, companion stress tests. We've alluded to the fact that this is now out in the water, so to speak, irrespective of the size of the bank. A lot of people, particularly showing large CRE concentrations, are being put under the gun to do far more robust companion stress testing. Now, we do know, I think most of you know, that the theoretical difference, if you will, between the top down and the bottom up. The top down is more the portfolio level. It is driven largely by call report or public data. It gives you the ability, of course, to do peer compare. The bottom up, of course, is again unique to your loan information in your non-public data, your DNA. And basically what that does, I think, gives a little more of a robust view of where some of the potential bubbling up of credit stress may be. One of the issues that anybody always has with stress testing, and even when it came out as a good practice 20 years ago, the flaw in the logic was that in theory it was sounding like you were underwriting your whole portfolio every quarter, which was totally impractical. So as we use stress testing, we always have to keep an eye on the integrity or the accuracy or the currency of the data being used. So one of the things we do here that I think is good, it's certainly good in my opinion for non-complex banks, is to take loan level stress testing with some key assumptions. For example, we will use often just two basic metrics, LTVs and debt service coverages. Think about it. LTVs arguably are a proxy for cap rates and market trends. They have obviously impact on the value of the property you're financing. Another, the two basic fundamentals of credit risk assessment are value of your collateral and the ability to repay the loan in terms of debt service coverage. We use debt service coverages as a proxy for interest rates and NOIs in the case of CRE deals. But again, I think while that's not a perfect science, because a lot of people say, well, where are your cap rates? Where are your interest rates? It's still, again, we're using proxies. The third leg of the stool for us is we use risk rating for what they are. The current risk grade is a proxy for both original underwriting and post-booking servicing. Again, it's not a precise science, but I think assuming that the bank has kept its risk rating reasonably accurate, that should be adequate proxies. And then on the last leg, of course, is to overlay all of this with some econometric data that is localized, as I've said earlier today, has to be localized to the lending footprint and the demand metrics of the individual loan product you're financing. So again, our companion stress test, which we like to do it often contingent or companioning with loan review, because in our world, we do this tasking our reviewers to recalculate loan to value and recalculate debt service coverages in real time based on whatever information is in the file, irrespective of what was either in the annual review or at original underwriting. We all know that that tends to change over time. And then I think most importantly, whatever you do, because I don't care what anybody says about stress testing, they're all, the bottom line complaint about stress testing, rightfully so, is it's highly theoretical, right? It's not a strong predictor. It just says, what if? What if this happens? Where would you be, particularly relative to capital levels? But what we do is also take it that last step and say, okay, at a loan level stressing, here's what you need to get in return. You need to see what the materially impacted credit or borrowers would be for your bank in a priority order if it should stress occur. For example, if we use 20% stress on LTVs, 20% stress on debt service coverages, these are the borrowers that you might need to be putting in the front of the line for any kind of concern. So I think it kind of wraps up the idea of that. So I'd like to again ask you, what types of stress tests have you all incurred? And that may be that you haven't done anything, but either a portfolio level, or which is top down, or bottom up level, which is more of the loan level. So that's actually good, because I'm a huge advocate of doing of both perspectives. I think they both bring a lot of unique value to you, but not either one of them is totally all inclusive of what you want to track for that. So 50% of you are doing both. That's very positive, I think. Okay, and then the other thing is to embrace collaboration. I can't overemphasize that. The loan review should not be hostile. It should be seen as nothing more than an extension of your credit risk team. It just is in a temporary mode of trying to give you an assessment based on a sample that can be extrapolated generally to the quality of your portfolio and how it's being managed. Again, that comes back all the way to the point of using seasoned reviewers, because they frankly have learned the ability to collaborate and to persuade if need be. And then finally, I think, again, utilize as much as it sounds like I've just gone back to old-fashioned way of having more senior people doing loan review. We're massively invested and very huge advocates of using all the technology you can do. And what I mean by that is, for example, the way we do it, and where I think most people should be aspiring to do loan review now, is you get rid of these very time-consuming and distracting and intrusive meetings with the credit people over here's a big data dump on all the exceptions we found. If you use technology, you've got the ability to eliminate that aspect of it and go kind of what we call real-time review of what reviewers are finding. We see the ability to clear exceptions in real time. We have uploading capacity to where you can chat and comment about a finding. It's also a way, frankly, one of our earlier clients made the comment, doing loan review this way gives me time to do my day job. It doesn't shut the credit function down just to quite in effect, babysit the loan review. Let's be perfectly honest about it. Those of you that use third-party vendors, that's like a variant of a regulatory exam. It's not as extensive, but it still is an intrusive process. So we've tried to use technology to eliminate as much of that intrusion and make it far more efficient as possible. Again, there's all sorts of upside around utilizing your technology, not only for loan review, but marrying that into some of the diagnostics that I just mentioned as far as slicing and dicing your larger portfolio. So these would be what I would consider to be the best of best practices in a kind of a new and in other words, it would suffice in what I think all are arguing, and you validated through the first question I asked in the poll today about what do you think credit environment looks like. I think it seemed to be universally that it's got some heightened risk in it. I will say in closing, and I'll get to the Q&A in just a moment, is that I was in California in February, and we did a credit conference largely with chief credit officers and senior lenders. And one of the senior lenders out there said, well, we dodged the recession bullet. It appears that we might be heading for a soft landing, which is still debatable. Every week or every day or every month, we have sometimes different indicators telling us where the general economy is going. But the thing that was interesting to me was how strongly this gentleman felt about we put the credit risk aspect of all this behind us, and we are on to focusing now again on loan growth. And I didn't argue with him directly, but I did intuitively, I said, something's kind of wrong with this. And so I went back to our team. I said, can you give me some empirical data that kind of gives me or counters that sense? And it really did come down to this, and that is, historically speaking, when we have arguably peaks of credit stress, in simple terms, historically, problem loans or non-performing loans may be as much as 12 to 18 to 24 months a peak after the Fed chooses to cap or start going down the downslope of interest rates. We all know what Chairman Powell said earlier this week, I believe, or last week. He all but tipped his hand that a rate cut is perhaps even imminent. But again, that's a short-term rate. Credit people have to deal in much longer-term horizons. And I'm here to say one of the things that we have to be sensitive of, that irrespective of the current rate environment or the trajectory of rates, traditionally what happens in our credit loan portfolios in terms of problems is they trail, again, 12 to 24 months after the Fed stops raising rates. We're in a wonderful slot in many ways. We're in a much healthy position, risk management wise, than we ever were at the beginning of the financial crisis. A lot of the inherent risk in the banking world has moved off of banking. It's gone, arguably now only CRE is the only loan product that commercial banking is the majority lender in. All the other loan products, there are other non-bank providers of that credit. The bad is, again, I think those of us associated with smaller banks, smaller regional banks, have to accept the burden of further defense of our CRE concentrations, and particularly our recent growth in CRE, have got to be defended if you're going to keep some regulatory concern down going forward. I will say this, and many may have heard me say this many times before, there's nothing more toxic in banking between a bank board and a bank management team, or a bank and its regulator, than too many credit surprises. It conjures up one of two things: either an incompetence issue, somebody's asleep at the switch, or perhaps even worse, a transparency issue. You knew it was a problem, you didn't want to highlight it for whatever reason. And I do think that's really an occurrence that has to be avoided at all costs. And I do see loan review as an absolute key pillar of adherence to not having too many credit surprises. I'll just close by saying we do offer it. We're agnostic, frankly, to whatever loan review work you do. We do have several clients that we license our process to. They do it only with third parties. We do some hybrid, like you said early in the survey, and we of course do third-party loan review. And again, we are now offering loan level stress testing that is often concurrent to or can companion with our loan review. I do think sorry about that. I do think the thing we love to do is in all due respect, if you would consider us for an RFP for 2025, we'd love to entertain that. We can get on a brief call, hear your sample requirements, and also show you the methodology we use to hopefully provide that more efficient, less intrusive loan review process. And I do think we do have some inducements to make sure that you get availability to use our very robust portfolio analyzer tool as well. Again, I will say this, I should have said at the beginning, this deck will be made available to everyone on the call today. And feel free to call me personally or anybody on our team, reach out to people that have used us. But I do appreciate very, very much your willingness to spend your valuable time today on this. And as far as the Q&A, Douglas has indicated, is there a benefit to doing quarterly third-party loan reviews versus semi-annual? We do several quarterly reviews, but oftentimes those are focused on what are quarterly originations. There's a limitation to the value of that. Obviously, that's more of almost a clerical aspect of it. I'm not a huge fan of just doing quarterly for all encompassing. I think semi-annual is fine. The reason I don't like just focus on new originations is those of us in the credit world have an old saying, I've heard it for years and years and years, and that is every loan is good for 18 months. And you're not going to pick up some of that because you're basically just validating the original underwriting and was the loan booked as approved. That they're the only thing. You're really not going under the hood around credit deterioration. I hope that answers that question. I do, and the other is question is, how often would you rotate your third-party loan review vendor, if at all? That's a legitimate question. I know in some cases regulators will suggest that. Sometimes that's their indirect way of saying, frankly, they're not quite satisfied with the quality of what they're seeing in the loan review work. They're not charged with or would never want to be caught as, quote, endorsing a particular third-party vendor or anything like that. And I do know under the post-Dodd-Frank, post-governance world we live in, there is some aspect of the value of rotational. But some of that is now mitigated, if you will, that, for example, 95% of the negotiations that I do with clients is through audit committees or risk officers, not the chief credit officer. In the 1990s, 95% of my negotiations was always with the chief credit officer. That dynamic has totally changed. Most credit departments now in banks are up to their necks in not only doing the spreading and the analysis and the structuring of loans, and thereby have lost some of the objectivity that function had years ago. So a lot of that has changed the dynamic of it. But I do think, relative to your point, it's really how good the quality is. I do think there's some truth to that. If you just haven't changed in years and years, that's fine to change. But I think it's simpler than just marking a calendar and say every third year. Hope that is, apologize, hope that's answering your question. I don't believe I see anything remaining in the chat or Q&A. And again, thank you, excuse me, thank you very much for attending. And we'll have this out to you in the next day. Take care.